Welcome to the Deep Dive. We're here to sift through the public data, the news, the charts. Basically give you the ultimate shortcut to being well-informed.
Exactly. And today we're doing a full journalistic report on the industrial conglomerates sector.
Yeah, focusing on 3 specific U.S. stocks that popped up on a basic screener looking for price over $10. We've got Honeywell, 3M, and then the much smaller Deluxe Corp.
We're going to try and blend, the fundamentals, the technicals, the latest news, see what's driving them, using data as of October 6, 2025.
These are big, diversified companies, the conglomerate idea, right?
Yeah.
Lots of different businesses under one roof.
That's it. And just before we dive in, it's probably worth mentioning.
Yes, the necessary bit.
Right. Look, this analysis, it's purely based on publicly available data. It's for educational, informational purposes only.
So when we talk about potential profits or losses, especially with our paper money math.
Yeah, that's all hypothetical. Strictly illustrative. It's definitely not financial advice.
Okay, got it. So let's kick things off with the biggest of the bunch.
Honeywell.
Sounds good, H-O-N.
Honeywell, H-O-N. I mean, this is textbook blue chip, right? It's in the Dow, S&P 500, even the NDX.
Absolutely, and the market cap reflects that. We're talking, what, about 132, almost $133 billion?
Yeah.
Huge.
And their reach, aerospace, industrial automation, buildings, energy, they're kind of everywhere.
They really are. And fundamentally, the picture looks pretty solid. You see high profitability.
Like the operating margin, over 20%.
Yeah, and
Okay.
profit margin around 14.3%. Healthy numbers.
The PE ratio is 23.76. A bit premium, maybe?
It is. But the forward PE is lower, down near 18.4, suggests earnings are expected to grow.
And that growth, PEG ratio is 3.14, highish.
A little high, yeah. Indicates the market might be pricing in that growth already, but the ROE, return on equity, is strong at almost 35%.
Okay, so stable, profitable. But what's the exciting part? Because the news flow seems pretty active.
Right, this is where it gets interesting. They seem to be actively reshaping themselves, moving towards future tech. You mean shedding old stuff and buying into new?
Exactly. They're dealing with legacy issues, like that big $1.68 billion deal to handle old asbestos liabilities.
Cleaning house. And spinning off Solstice Advanced Materials, too.
But the big catalyst, the one everyone's watching, is Quantinuum, their quantum computing subsidiary.
Yeah, this $600 million equity raise at a $10 billion valuation, pre-money.
Insane numbers. And NVIDIA chipping in adds serious credibility. This isn't just industrial parts anymore. It's potentially next-gen tech leadership.
Okay, so fundamentals solid. News is exciting. Why isn't the stock ripping higher then? What do the technicals say?
Well, that's the interesting part. The technical picture is a bit mixed right now. Gives us some clear potential triggers.
Current price is $209, but it's below its key moving averages, SMA 20, 50, 200.
Correct. Below the 20-day by about 0.7%, below the 50-day by almost 3%, and the 200-day by nearly 4%.
So short-term trend has been down, bearish.
It has. But look at the RSI, the relative strength index. It's down at 39.38.
Getting close to that oversold territory, like below 30.
Exactly. So that could be flashing a potential buy signal, suggesting it's maybe gotten too cheap relative to recent action.
But potential is the key word, right? Needs confirmation.
Absolutely. So the trigger points. A buy signal might be confirmed if the price convincingly breaks back above that SMA 20, shows momentum shifting.
And a sell trigger.
If it keeps drifting lower, maybe breaks recent support, and those SMAs keep pointing down, that would suggest the downtrend isn't over.
Okay, let's do the paper money math. Hypothetically, say you invested $5,000 about 6 months ago.
All right. 6 months ago, HON was trading around $190.99 a share.
So $5,000 would get you about 26 shares.
Yep, 26 shares. For an initial cost just under $5K, say $4,965.74.
And today at $209 a share.
Those 26 shares are worth $5,434 a share.
So the paper profit of $468.26.
Right, about a 9.43% gain over 6 months. Solid, steady, kind of what you'd expect from a blue chip.
But maybe a little underwhelming given that quantum news. That's the debate, I guess.
That's the question yet.
Yeah.
Is the market fully pricing in that future potential yet?
Okay, let's move on. Next up, 3M, ticker MMM, another giant brand.
Also in the Dow and S&P 500. Market cap around $83 billion, so smaller than Honeywell, but still massive.
Post-it notes, scotch tape, but also high-tech stuff in healthcare, transportation, electronics.
Very diverse. But 3M feels like a different kind of story right now, doesn't it? More
Yeah.
complex, a turnaround maybe?
Yeah, the numbers look kind of wild in places. That debt-to-equity ratio, 3.20.
Well, it's very high. That's a lot of leverage. Basically, 3 times more debt than equity on the books.
That feels risky, no. Like you said, high leverage.
It definitely adds risk. And look at the price-to-book ratio, PB. It's over 19.
19 times book value. So the market values its brand and potential far more than its physical assets.
Hugely. It suggests immense faith in intangibles, or more likely in this turnaround story taking hold.
Because some of the return metrics are just off the charts. EPS year-over-year TTM, up 325%.
Yeah, that's a dramatic recovery number. And the return on equity, ROE, is 96%.
96% ROE, how is that even?
It reflects the recent earnings surge against the existing equity base. The market is clearly rewarding whatever changes they're making.
And the news seems to back that up. Strong earnings recently.
Definitely. Q2 2025 was a solid beat. They raised their full-year guidance.
And the analysts jumped on board. Wells Fargo, UBS, BofA.
Yeah, a wave of upgrades. They're talking big targets, too. 25% margin expansion, launching 1,000 new products by 2028. Serious operational push.
Okay, so high jet, but high recent returns and a clear strategic push. How's the chart look?
Technically, 3M looks arguably the strongest of the three right now.
Really? How so?
The price, currently $155.93, is trading above all the key moving averages. SMA 20, SMA 50, SMA 200.
Okay, so that's different from Honeywell. Price above the averages is generally bullish.
Exactly. It suggests positive momentum across short, medium, and long term. That's a pretty clear technical buy signal structure. The uptrend seems intact.
And performance reflects that. Up nicely this year.
Oh, yeah. Up over 20% year-to-date and almost 23% over the last 6 months. It's trading pretty close to its 52-week high, too.
The market seems to be buying this turnaround story then.
It certainly seems that way based on the price action.
All right, paper money time again. Same $5,000 hypothetical 6 months back.
Okay. 6 months ago, MMM was around $126.91 per share.
So 5 kilo gets you 39 shares. Just checking the math.
Right.
Yeah, 39 shares.
Right, for an initial cost of about $4,950.40.
And now at $155.93.
Those 39 shares are worth $6,081.27.
Okay, so the paper profit here is $11,130.87.
A much bigger jump than Honeywell, about 22.87% gain on paper.
That's the highest absolute dollar gain so far. Shows the power of getting into a turnaround if it actually works.
But also highlights the volatility, right?
Oh.
Higher potential reward often comes with that higher risk profile we saw in the debt figures.
Okay, finally, let's switch gears dramatically. Deluxe Corporation, DLX.
Yeah, we're going from giants down to, a micro cap, really. Market cap under $900 million, $869 million to be precise.
Known for printing checks, right? That's the legacy business.
That's the classic image, yeah. But they're trying hard to pivot into merchant services, B2B payments, data solutions.
Feels like a tough pivot.
Mm-hmm.
How does the numbers look? Is it a value play?
Potentially. I mean, look at the forward PE. It's just 5.19. Very low.
Wow. Okay. And price to sales is also low, 0.41.
Yeah, suggesting it might be cheap relative to future earnings and current sales. Projected EPS growth next year is decent, too, around 9%.
But there have to be risks, right?
Yeah.
Especially with that legacy business.
Oh, absolutely. Let's talk about that dividend. The yield is huge, 6.29%. Very attractive on the surface.
There's always a but.
The payout ratio is over 100%, 101.69% TTM.
Meaning they're paying out more in dividends than they're actually earning.
Precisely. That's not sustainable long term. Yeah. It screams potential dividend cut if things don't improve fast.
And the balance sheet, liquidity issues.
Yeah. The quick ratio and current ratio are both below 1, around 0.85 and 2.94.
Okay, translate that for us. Less than 1 means.
It means they might struggle to cover their immediate short-term debts if revenue took a sudden hit. Limited cushion.
So low liquidity, high debt too. Debt to equity is 2.39.
Yeah, quite leveraged for a small company trying to transform. High risk profile here.
So a legacy check printer with liquidity concerns is launching a generative AI platform, DAX.
Yeah. It sounds almost counterintuitive, doesn't it?
Either brilliant or desperate, maybe?
It shows the pressure they're under to innovate and find new revenue streams. They acquired CheckMatch from JP Morgan for digital lockbox stuff, partnered with banks. They are actively trying to change.
Okay, this is interesting. What are the insiders doing? Are they buying this story?
That's maybe the most compelling part. Unlike the giants where insider ownership is tiny, here the CFO, William Zint.
Yeah.
She's been buying shares. Multiple purchases reported recently, September, June, March of this year, 2025.
Huh. An insider putting their own money in? That's often seen as a strong positive signal, isn't it?
It definitely is. Shows conviction from someone who knows the business intimately. And Wall Street analysts seem optimistic too.
Target price suggesting significant upside, like 36% potential.
Yeah, the average target is up around $26.75 compared to the current price near $19.37.
Okay, technically, how does it look? Has it performed well recently?
It's had a very strong run lately, actually, up almost 30% over the last 6 months. That's the best percentage gain of the three.
Despite being down for the year overall.
Correct. Year to date, it's still down about 14%, but recent momentum is strong. Price is above the 50-day and 200-day moving averages.
Good medium and long-term signals.
But it just dipped slightly below the short-term 20-day average.
Okay, so another watch closely situation.
Exactly. The medium-term strength is there, but this little dip needs watching. A clear break back above the SMA 20 would be your buy confirmation.
And a sell trigger, falling below the SMA 50.
That would be a concern, yeah. It could invalidate that recent bullish momentum. High beta 2, 1.45, so expect volatility.
All right, last round of paper money math. $5,000 invested 6 months ago.
6 months back, DLX was trading around $14.95. Cheap stock.
So 5K would have bought quite a few shares.
Right.
334 shares.
Yep, 334 shares for an initial cost of about $4,993.30.
And today, at $19.37.
Those 334 shares are worth $6,477.58.
Wow. So that's a paper profit of $1,477.28.
The highest percentage return in our group, nearly 30% gain on paper over 6 months.
Underscores that high risk, high reward potential perfectly. Big gains if the transformation works, but significant underlying risks. #tag outro.
Okay, so let's try and synthesize this. 3 conglomerates, 3 very different stories playing out right now.
Definitely. You've got Honeywell, the stable giant, using innovation like quantum plus smart divestitures, driving pretty predictable, maybe slightly conservative gains.
Then 3M, the big turnaround, focusing hard on efficiency, new products, generating strong profits recently, but carrying that heavy debt load if they stop.
Yeah, that leverage could bite back hard. High reward, but definitely not low risk. And finally, Deluxe, the small cap value play. Huge percentage gains recently, showing the market's hope for its digital transformation.
But balancing that against real risks. Liquidity, that unsustainable dividend, the challenge of pivoting from checks to AI.
What really stands out, though, looking across the three, is the ownership picture, isn't it?
It's fascinating. Honeywell and 3M, massive institutional ownership, like close to 80%. But insiders own almost nothing, 0.1%.
All the conviction seems to be external, from the big funds.
Right. But then you look at Deluxe, much smaller, riskier on paper.
Yeah.
Yet the CFO is actively buying shares with his own money, multiple times this year.
So that leaves us, and you the listener, with a provocative thought, maybe.
I think so. When you're looking at a sector undergoing change, like industrials adapting to tech, which signal do you trust more?
Is it the overwhelming institutional money pouring into the established giants like Honeywell and 3M? Betting on stability or a well-managed turnaround?
Or is it the quiet, personal conviction shown by an insider like the CFO at Deluxe, putting his own skin in the game on a riskier but potentially more transformative bet?
The charts and fundamentals tell part of the story.
But sometimes, following the insider money might give you a different, perhaps even more valuable perspective, something to think about.